want to just, on the areas what we had done, just to look at some of these questions again.
Okay.
And then we can go on to the next subject, that is basically we wanted to do the reporting. So shall we look at some, because these are typical questions that have been put up. So here we have this company, Linens company, made a profit before interest and taxation 950, net interest was 50, tax 100,000. In addition to a nominal issued share capital of 3 million, there are 1 million 10% preference shares in issue with a nominal value of 1. What is the profit figure to be used in earnings per share calculation? So what we know is earnings per share calculation, the profit figure to be used is profit available for the equity holders. Profit available for the ordinary shareholders. So that is after paying interest, after paying everything, and in this case, even after paying the preference dividend. That is what it makes it. So, so what is the figure we are getting? So we are starting off with 950 profit before interest and taxes, and then we have to pay the taxes 50. So then we come to 900 interest, then we pay 100 taxes, 800. So this is the normally the profit after tax which is available for the shareholders. But here from this we have to pay for the preference shareholders a 10% dividend. 10% dividend. Share capital of 3 million. In addition to the nominal share capital of 3 million, there are 1 million 10% preference shares. So on the 1 million, we have to pay 10%. That is 100,000.
Yeah. So it would be 700,000.
700,000 is what is available for the shareholders, and that is what we call the earnings. And from that, on that we have to divide it by the number of shares, and that will give us the earnings per share. Right?
Yeah.
So the next one. Anthony Incorporated. So Anthony Incorporated means it's a listed company, achieved earnings per share of 25 cents and paid a dividend of 0.5 cents per share for the year just ended. Anthony's PE ratio is currently 13. Its comparatively data for the previous year was SOMA 20 and 4 earnings per share, the dividend per share, and the PE ratio 12.5. Dividend yield 1.6. But the total shareholder return. So remember I told you what is total shareholder return is. Total shareholder return is dividend per share and the capital gains per share. Total shareholder return. So total shareholder return is TSR is equivalent to dividend per share plus the capital gains per share divided by the opening share price as a percentage. So we are asked to calculate the shareholder return in the current year. So what we know is they paid a dividend of 0.5 cents for the just year ended. So that means that is the dividend per share, 0.05. Now the capital gains. To calculate the capital gains, we need to have the share price at the beginning and the share price at the end. Now you can say that figure is not available here. So how are we going to get it? So we have to get the share price at the beginning and the share price at the end. So what we know is PE ratio. PE ratio is price divided by earnings per share is equivalent to PE. So from this ratio we can find out the price of the share is equivalent to PE times earnings per share. So these are the calculations that probably you will get it. Little calculations. Right? So price is equal to PE times earnings per share. So this year we know the PE is, they say 13. So current year it is 13 times earnings per share. Earnings per share they say 0.25. 0.25. Right? So that will tell you the current year share price. How much is that? 13 into 0.25. That is the current year share. So if a company gives you the P ratio and the earnings per share, we can calculate the market price per share. Market price per share is equivalent to P times earnings per share. So 13 into 0.25 is the today's share price. How much is that?
Uh, 52.
13 into 0.25. 13 into 0.25. 13 times 0.25. How much is that?
3.25.
3.25. That is the share price as at today. Today. So we can work out the share price at the beginning of the year, same way, because we know the earnings per share was 12.5 at the beginning, and the price earnings ratio was 12.5, and the earnings per share was 0.20. So that will give us the beginning share price, 12.5 into 0.20. How much is that? 12.5 into 0.20. Yeah?
Yep, it's 2.5.
2.5. So 2.5 and 12.5 will tell us so 2.5. So at the beginning it was 2.5 and at the end 3.25. What is the capital gains? Capital gains per share is the difference between these two, isn't it?
Yep.
Yeah. So that is 0.75 is the capital gains. Yeah. Capital gain. So the dividend per share is 0.05 and the capital gains per share is 0.05, and this is what the total returns what we got. So we have to compare with the opening share price. Opening share price is 2.5. So it is 0.75 in plus 0.05, right? 0.75 plus 0.75 plus 0.05 divided by 2.5. So that will tell us the into 100 will tell us our ratio. How much is that?
Yeah. Should you know where you've got 2.5?
Yeah.
Shouldn't it be 0.25?
Shouldn't it be? No, the share price
Yeah.
12.5 into 0.20. How much is that? 12.5 into 0.20. Take the calculator and work it out, then it's easy.
No, sorry. I'm saying that you know where you've got 0.5 plus
0.75.
Yeah.
Yeah.
And okay, so, and the 2.5 is the capital.
The share price at the beginning of the year. Share price at the beginning. not the earnings per share. It is the share price at the beginning of the year. But we are trying to compare is because if you have invested 2.5 on a share, you would have got a 5 cents dividend and a 75 cents capital gain. You know, at the beginning of the year, if you have invested $2.5 on a share, at the end of the year, you would have got a 0.5 cents dividend and a capital gain because the share what you bought for $250 has gone up to $325. So the total income what you got was a 0.75 and a 0.05. Is it clear?
Yeah, but the 2.5 at the bottom, where did you get that from?
2.5?
Yeah.
That is the beginning. Now, opening share price. This is what I calculated here.
Okay.
Right? But it says is initially the share price at the beginning of the year was 2.5. How did you get that one? We know the P ratio at the beginning of the last year and the share price and the earnings per share. So the last year, at the end of the last year, the share price was 2.5, right? 250. And at the end, at the close, it is 325. So there's a capital gain of 75 cents. And also a dividend they have paid during the year, 5 cents. So 80 cents is your total return on a capital investment of 250. That is what it means.
Okay, yeah, I got you.
Yeah. 250 on a capital investment of 250. So now in this question, you can see they are not given an answer. So we have to put our answer. So it comes to how much? 80 cents, 0.8 divided by 2.5. 0.8 divided by 2.5. It comes to how much? 0.8 is the dividend what you got. And the capital gain is 2.5, the share price. So how much are you getting? 32%. 32% you are getting. Yeah?
Yep.
That is on a 250 share, you have got an 80 cents return. So this is what the answer here should be, 32%. Is it clear?
Yep.
Right. So this is what this surely will be a question for your exam. This calculation of the total shareholder return. Right. Then the next question. The figures in so these ratios are very important. The figures in the table below and expect from the income statement of Arnell Company. Arnell has 3.5 million ordinary shares in issue. Nominal value 50 cents each with a market price of $2. Profit before tax 2.5, less taxes 0.75, profit after tax 1.75, ordinary dividend they have paid $500,000 and a preference dividend 25. What is the dividend yield? So again, remember when they talk about the dividend yield, they are talking only about the equity shareholders or the ordinary shareholders. So dividend yield is dividend per share divided by the market price per share into 100. Dividend per share divided by. So first of all, we must calculate the dividend per share. So they have paid a total dividend of 0.5 million. 0.5 million means 500,000. They have paid it as a dividend. How many shares they have? Number of ordinary shares? 3,500,000. Yeah, 3.5 million.
Yep.
3,500,000 ordinary share. So from there we can find out the earnings per share. We can find out the dividend per share. Dividend per share we can find it out. How much is that? Dividend per share. How much is the dividend per share?
Uh, 0.14.
Yeah, 0.14. So that is your dividend per share, isn't it? Then we have to find out the market price per share. So the market price per share, they have already given it, right? It is now the nominal value we take. We take it, the market price is $2.
Yep.
So $2, 0.14 into 100% will give us our return as a percentage. So in other words, what it says is on a $2 investment, I get a 14 cents return. That is how much as a percentage?
7%.
7%. So that is the answer should be A there.
Yep.
Answer should be A. What is important is to know exactly which to apply at which stage. That is what we need to know. So that's the third question. Let's look at the fourth question. The projected income statement of ST company for the year to 30th June shows the following figures. Operating profit 100, interest payable 40. So operating profit, always remember, it is profit before interest and taxes. That is what we call the operating profit. Profit before interest and taxes is what we call the operating. From there, they have paid 40,000 interest and profit before tax is 60. Corporation tax is 80. So profit after tax is 42. Directors estimate that the additional purchase of new equipment on July 2010. So this is the budgeted for the year 30th June 20. That is for the next year. So at the beginning of this year, they expect if they purchase equipment for 140,000, it would increase the projected profit before interest and tax for the year by 18,000. So what is the profit before interest and taxes at the moment? 100,000.
100,000, yeah.
100,000. So what they say is if they buy a new machine, that is going to increase their profit before interest and taxes by 18,000. So your new PBIT will be 118,000.
18,000, yeah.
118,000. Machine would be financed by a new loan raised on 1st July with a coupon rate of 5%. So coupon rate means the interest rate. So they are going to buy this machine with a new loan, which is going to give them, they have to pay 5% interest. So the cost of the machine is 140,000. So they will take a loan for 140,000. On that, they have to pay 5% interest, which is 7,000. Right? Which is 7,000. So your interest cost will be next year 40 plus 7. Already you are paying 40 plus another 7,000 on the new machine. So your total interest cost will be 47,000. Right? So SD has a covenant on an existing loan that interest cover will remain above 2.2. What is the interest cover? Interest cover is always profit before interest and tax divided by the interest or the finance charges. Profit before interest. So now what we see is if we go with the new machine, we are going to have 118,000 profit before interest and tax, and our interest payment will be 47,000. So 118,000 divided by 47,000 is my debt interest cover. That is how much.
So the interest, yeah, it's 2.51.
Yeah, 2.51, and the debt covenant is not broken because the debt covenant should be above 2.2. So the answer should be B. Correct? So what you need to do is just you have to know what you really want it. If you can quickly do it, you are collecting lot of marks on this question. This is the advantage I see in objective test because you don't need to think too much. You can just, if you know the things, you can just answer and collect your mark. So then the 1.5. In the context of the managing performance in not-for-profit organization, which of the following definition is least accurate? Now this is someplace sometimes our English can get really stuck because some of the languages that they use or we see something not easily understandable. In the context of managing in not-for-profit organization, which of the following is least accurate? That means what is the least accurate or what is the wrong one? Wrong one. Value for money means providing a service in a way which is economical, efficient and effective. Is it right? Yeah, so that is all right. Economy means doing things cheaply, not spending two when the same thing can be bought for one. Correct?
Yeah.
Yeah, that is also right. Efficiency means doing things quickly, minimizing the amount of time that is spent on a given activity.
No.
No. No. Effectively means doing the right thing, spending funds so as to. So you can see it is the answer should be C. Now some questions it may be easy for you to eliminate the other three and then by default answer should be C. Because surely A, B and D are right answers. So the least correct answer should be the C. So that is what it should be. So that is 1.5 should be C.
Yep.
Then we come to a study. Then the next one, I think we have already done this kind of a question earlier. Debt steady increase is likely to be the financial objective of a public listed pharmaceutical
company. Yeah, pharmaceutical.
So you can see this kind of questions are coming up all the time. Very standard, very standard questions. So these are the papers that the examiners have said. So probably we will have this kind of question. This was a tricky one, if I remember right. This was a tricky one, if I remember right. So, balance scorecard to assess its performance. In this context, which two of the following statements are valid criticisms of return on equity as the sole financial performance measure? So, what they say is the company is using the balance scorecard. It is using the balance scorecard. So, when you are using the balance scorecard, in that context, which two of the following are valid criticisms of return on equity as the sole financial? It can lead to excessive risk-taking, right? It can lead to neglect of non-financial objectives. It can discourage investment in the new assets. It does not consider cash flow issues. So, if you go with the return on equity as your one of the objectives, what is the in this chapter which are the valid criticisms? In the sense,
it can lead to neglect of non-financial objectives.
Okay, right. Then, okay. Look at okay.
Sorry, say that again.
Yeah, look at what is return on equity. Return on equity is the profit available for the shareholders divided by the value of equity. Right. So when you are working on that statement, on that thing, what are the things that you can ignore, you may miss? That is what the question is all about. That is what the question is all about. What are the things you can miss? If you are going on return on equity as one of your objectives, and also if you have the balance scorecard working, what can you miss in that thing? What is the criticism that can be laid? What I will do is, this is a tricky question because almost all are very correct, right? So what I do is I'll try to eliminate as much as possible. Now one thing what we know is return on equity, whatever the way we do it, it is not going to consider the cash flow issues. Okay, it is going by it is going by the profits. It is going by the earnings. You may not have enough cash, but you may have earnings, and in that case, the measurement is okay. So that is one criticism that can be placed up. So I know that, number 4 is surely should be part of my answer. Now, when I do that one with this kind of a question, if I was sitting the exam, I will see it has to be now by the process of elimination, it has to be either A or D. Because in the B and C, I don't have the one.
Yeah.
So now I have to decide between the 2 and the 4. It can lead to neglect of non-financial objectives, or so that is number 1, right? Or it can, and in both the cases we have sorry. Now I said the 4 I will take it up. Right?
Yeah.
I will take up the 4 because the 4 is definitely there. So with the 4, the 2 answers, probable answers are C and D. Right? The probable answers can be C and D because in the A and B, you don't have the 4. I know definitely 4 should be in the answer. So now it's my life is easy now. Now I have to decide between C and D. C is about the trade. It can discourage investments in new assets. Trade. And the other one is in the fourth one, the one, it can lead to excessive risk taking. So we have to decide between that one.
Yeah, it would be 1. It can lead to excessive risk.
Because when you are going on return on equity, the directors will definitely want to take bigger risk. They will want to take the bigger risk. So they can take excessive risk because they will be using, they may increase the gearing and all that kind of a thing, and that can mean excessive risk for you. Actually, why you can see actually all the answers are almost correct, but the number 2, you are right, but it is because we are implementing the balance scorecard margin, it will get highlighted. it will get highlighted because we are focusing on non-financial objectives. So immediately it will get highlighted. So that is why it is, and it can discourage investments in new assets. That is also not an impossibility, right? It can discourage the investments also. But there again, when you look at from a long-term point of view, that may not be the scenario. So most likely the answer should be D, 1 and 4. Correct?
Yes.
Right. So now let's look at the next one. Which of the following ratio would be most appropriate to use compare the profitability of two companies that operate in the same line of business? So profitability ratio. So there again, we can very easily eliminate most of the thing. Interest cover is not a profitability ratio. It's more of a lender's ratio. Earnings per share could be considered a profitability ratio because that is trying to consider the profit, right? Price earnings multiple is more of a market ratio of share pricing more than a profitability ratio. So we now come to A and C by the elimination process. So there we have to decide what is the most appropriate to compare the profitability of two companies that operate in the same line of business. A or C?
I'd probably go with A.
Yeah, right, because the number of shares can change from one company to the other company, right? One company may have few shares, other company may have more shares because it depends on your dividend policy, your capitalization policy and all that kind of a thing. So to that extent, the number of shares, earnings per share is not a comparable figure. But the return on capital employed on a similar business, same line of business, you must have a similar return on capital employed. Then the final question I have is, following is an extract from the accounts, turnover 350, operating 125, interest payable, so on, so on. But STF company's earnings per share. So earnings per share is always what? Earnings per share is the profit available for the shareholders after paying everything. So turnover doesn't matter. Operating cost is 125. So sorry, operating cost is 125. So 350 minus 125 will tell us the profit before interest and before interest. So 350 minus 125 will give us
225.
Yeah, 225. And from there you have to deduct the interest 50, 175. And from there you have to deduct my tax as 50. And this is the profit available for the shareholders, right? Because there are no preference shares here. So this is your earnings, 125. And the number of shares, in issue is 1,000 million. 1,000 million. So 125 divided by 1,000 million is your earnings per share. 125 million divided by 1,000 will be your earnings per share, which is $0.125. Okay?
Yeah.
Earnings per share. And then the price earnings per share is price divided by earnings per share. So we are told price is 300 cents. So now this is another tricky area you may come across. When you say 300 cents, right? Either you have to put it in cents or you have to put it in
dollars.
So whatever it may be, you have to put it in the same thing. So you can put it in cents. If it is 300 cents, if it is 300 cents, what is this thing? Earnings per share. Earnings per share. Earnings per share, they are given it as $0.125. So $0.125, you have to convert it into cents. In that case, it is 12.5 cents. Correct? Because if you are going to go on this thing, you have to go on, if you are going on dollars, all the cents, 300, and $0.125 means 12.5 cents. So 300 divided by 12.5 will be your P ratio, which works out to 24, I think. Yes. Right?
Yep.
So these are type of questions. So what I'm going to do is now I have, we have worked out some questions. So I'm building up a question bank. I'm going to send you some questions for you to try it. Even these questions that I send it to you now, you can again try it. And hear the recording. You can hear the recording. You can test the answers. But I think it's good for you to try these questions. And that is the way you will practice this OT question. OT setup.
Yeah, definitely. Yep.
This is the most helpful tool I think we have, because we can practice these questions truly through this one. Right. So now I want to move into another new area, which is basically called the financial reporting part of it. Right. So that is what we are going to look at today. What we basically say financial strategy reporting issues. So what are the reporting issues that we have in our financial strategy? So basically what we see is the basic statement what we prepare to the shareholders, to the people, is our financial statements. Right? Financial statement is the statement that is giving information to the shareholder. But we know that statement has lot of limitations. For the investor, for the stakeholder, your financials, what are your financial statements, Majid?
Sorry?
What are the financial statements? When you say financial statement, it has
balance sheet.
Yeah. Now we don't call it Now we don't call it balance sheet. Now we don't call it balance sheet. The first statement is comprehensive profit or loss statement. Number one. Number two, statement of financial position. The balance sheet is called statement of financial position. Then the number three, statement of changes in equity. Right?
Yeah.
Number four, statement of cash flow. And number five, accounting policies and notes. These five statements together is what we call the financial statements, according to the framework for preparation of financial statement. So these five statements should be there for you to call it a financial statement. But what we know is nowadays for the investors and the prospective investors and the directors and everyone, these statements are not good enough. We need much more than that. So first of all, we must understand what are the limitations of financial statement. So many people will try to read the financial statement, but they will find lot of limitation. So one thing we have to understand is what is the objective of financial statement. Objective of the financial statement is to provide information about the financial position, the performance, the changes in financial position, what are useful for a wide range of users to make economic decisions. So remember the definition, wide range of users, not only the shareholders, the lenders, employees, suppliers, all the stakeholders. Whoever who wants to make economic decision, the financial statement should provide. They are providing information about the financial position, performance, etc., etc. But what we know is financial statements alone are not sufficient enough, right? Unless you give some explanation for the performance. So the framework acknowledges that it does not and that it cannot provide all the information that the potential shareholders and the existing shareholders want. So this is something we want to discuss it. So what are the limitations? Why is the financial statements not good enough? Why not good enough? So you can see why it is not providing useful information. As you can see, this rabbit, he is trying to run forward, keeping his ears behind. And that is exactly what the financial statements are looking at. It is very much backward looking. It's all about the past. It's all about the past, right? and lot of information given. People cannot read, understand what it is like. Unless you are a accountant, you won't understand anything like that. And even with the financial statements, we saw a lot of accounting scandals. People losing confidence in the financial statements. Then the corporate social responsibility has become such a critical one, but your financial statements does not have anything about that one. Then the different stakeholders, they have different requirements, and the financial statements are very much primarily shareholder oriented, because the auditors are appointed by the shareholders, they are the owners, so mostly the financial statements are looking from the shareholder orientation. Backward looking, information overloading, and even if you want to give something about the future, management is somewhat scared because it can be speculative. They don't want to give wrong prediction. So the past financial performance, good or bad, may not mean that the future is going to be the same. Sometimes a good company with a past record may be going through a bad patch in the future. Or sometimes a bad company in the past may come up well. So the investors will not know reading the financial statements what the future is going to be. Right? And the financial statement does not talk about the changes in the senior management. You and I know when a senior management changes, like the CEO, the performance can change. So it does not tell anything about the changes of CEO or anything like that. It does not talk about any loss of major customers. Maybe last year you had some top government orders, but this year you are not going to get it. But it is not disclosed in the financial statement. So the people who are going to make decisions, they will be making decisions in darkness. They are not going to talk about the competitive environment, right? What is your competitive environment? What is the competitive strategy? And what is your response to that one? Your financial statement does not, because it is purely 5 different statements that is going to give you. It is not talking about the company's future prospects at all, or about the research and development. How much are they going to spend on research and development? Remember, without research and development, if you try to run a company, you will not go that far, because others will come out with new innovations and you will be out of date. Right. So new marketing campaigns, new pricing strategy. The shareholder is kept in darkness. The prospective shareholder is kept in darkness. The existing shareholder is kept in darkness. Then financial statements can be altered by certain types of reserves. There are certain statutory reserves. It can make a big change in the financial statement, like capital redemption reserve fund and all that kind of a thing. There can be some extraordinary expenditure coming up in a particular year, and that can have a distortion of your financial statement. So basically, to get a big picture of your financial performance, at least you must have 2 years of comparison. Right? That is why we said even the ratios, we need the comparisons. Auditor statements can be subject to a lot of manipulation. We know with the accounting standards and all that, there can be. Then we have something called off-balance sheet items. What are off-balance sheet items? Like these operating leases, right? You have obligation, but that is not reflected in your financial statements. You have taken a vehicle for hire for next 3 years, but it is not reflected in your financial statements because you are considering it as a operating lease. So that's a liability that may be there, right? And the financial statements will not really guarantee that everything is happening right. So because of all these reasons, financial statements alone is not good enough in the 21st century what we are living. And particularly, the companies are being attracted by the environmentally conscious investors. The investors are becoming very much environmentally conscious. So if you are doing very well on the environmental area, probably people will invest in your company. Otherwise, people may not get attracted to your company because the society is very concerned about the environment. If you are going to pollute the environment, you are guaranteed the society will not accept you. Society will reject you. So these are, because of all these things, our present financial statements are not good enough or not a good tool. I mean, when I say not a good tool, it's not really bad, but it does not provide everything what we require. So, the stakeholders, different kind of stakeholders want different kinds of information. You can see in the picture here, different people want in different information. Financial information, future prospects, management of the business, social responsibility, what are you doing in the social arena, environmental policy, the risk management. So these are the information what a stakeholder will expect from the company. So you can see the financial statements alone is not providing most of this information. Except for the financial information, the balance is not provided. No future prospects, no management business given, no social responsibility, no environmental, no risk management, nothing set up as basic financial statements are concerned. So, because of that, there had been a need for increased scope of reporting. The people are looking for bigger things. So, for that in mind, there are a lot of new reports that have been introduced. One is operational and financial review. So, this is not mandatory, but the UK companies are encouraged to produce a OFR. That is to assess the results of the current period. You try to tell the investor how you achieve this profit. You try to assess it and say it is satisfactory or not satisfactory and all that. And also about the future trends. Will it continue? Will it go to increase or will it come down? So the directors have a responsibility cast to the OFR to keep the customers informed, the stakeholders informed of the future. Okay?
Yep.
Then we have something, a new thing that has been introduced by the IFRS principles, but is called the management commentary. Management commentary. Now that is basically the management will give what we call a non-binding commentary along with the financial statements that have been prepared. So what does the management commentary tell you? So it should basically provide the management's perspective or management's understanding of the entity's performance, position and progress. So it is like a OFR. It goes little beyond the OFR. It is going to explain the management's understanding of the performance. The management will say, according to our view, the company has achieved substantial growth. Or we are not satisfied with the growth, the progress and all that kind of thing. And it should supplement and complement information presented in the financial statement, much more than what the financial statements are going to give. And also a kind of orientation for the future, right? And also the qualitative characters of relevance and faithful representation. So the management committee will say, in our opinion, that as far as the directors are concerned, we feel that we have give the information what they have given is a faithful representation. So it's a very positive kind of a communication by the management saying that the company reports are truthful kind of a thing. Because the reason is lot of reports are not truthful earlier. So it's basically a narrative report, which is giving you the financial precision, interpretation. Normally, otherwise, what have we got to do? We have to do the interpretation. We have to look at the ratios and interpret it. But now the management commentary gives a report giving an interpretation. So I'm sure in the strategic paper case study, this is where they will be coming up. Right? They will give us the management commentary and they will ask us to evaluate that management commentary as a potential investor. Then about the environmental reporting, the corporate's environmental responsibility and what are the effects on its activities on the environment. It's not only a question of we being affected by the environment, it is a question of how much we are affecting the environment. How is noise pollution? How is wastewater treatment? How is air pollution? All that, how are we as our responsibilities to it. Social responsibility, I think a very important one, right? It basically the social awareness, the social responsibility. Because as I've been always telling, today the business survives because the society accepts it. The day that the society says, we don't want your business, you're out of business. So because of that, in turn, you have a responsibility towards the society. Human resource reporting, right? Now, we know in our financial statement, human resource, we know it's an asset, but it is not reflected as an asset. Right? It is not reflected as an asset. There have been arguments, commentaries, seminars, conferences going for last 25 years, but still they have not found a method to put a value on the balance sheet or wherever, the value of the human resources. But you and I know the value of the human resource. You have a good, top-class, brainy, clever CEO, and another company, the same business with a old, lethargic kind of CEO. You know the difference between the two organizations. How is it coming up? Is it because of the machines? Is it because of the product? No, the product is same, the machines are same, but it is the CEO's involvement, CEO's activity. So that is why the human resource is a very, very important thing. Can you think why the human resource is not recorded as an asset in your financial statement?
Because there wouldn't be like one, like there wouldn't be a really good way of doing it.
Yeah. One thing is the
and it wouldn't be accurate as well.
Yeah. One thing is the definition for the asset that is given in the framework basically says asset is an economic resource which is going to bring you future benefits to the company and which is controlled by the entity. Now that is where the problem is. Human resource, yes, it's a resource. It is going to bring you an economic benefit all the time. But the problem is you can't control the human. You can't keep him tied up. You can't tell him to work for 10 years. You can't kill him because he's a person with a freedom. So because now machines you can control, machines you can switch on, switch off, you can do it. But human beings you can't do that one. That is the main reason why the human resource is still not coming up. And the measurement itself is a problem. Because we have a dignity as human beings, we have a value. So I don't want to feel that, I'm valued lower than you. Or you don't want to feel that you are valued lower than me. So when you put up values, it takes that human dignity out. We know there's a kind of a value because SEMA qualified accountant what is paid and a part qualified accountant what is paid and a non-qualified person what is paid are 2-3 different things. But we don't want it to come up in the public document saying the value of us is. It is not the value. So the humans are not valued for those reasons. But however, you must report about human resources. Because the investor would like to know what are your managers, how many managers are there, what are their qualifications, right? What are they doing, how long they have been in the company. You can see in the strategic case study all the time they give you the board and the senior management's profile. Because that way you know that, yes, this company has experienced people. Then the new thing that is developing very fast is what we call the sustainability reporting. What is that? It is basically the report about environment and social reporting. So this is the report that is really developing, and this is what is going to cause lot of problems, not really problems, but something which we have to focus. So that is what the scope of reporting, how it is going to increase. Sustainability. What is sustainability? Sustainability is whatever we do, we must look after the younger generation. We must not do things selfishly, spoiling the future of the younger generation. This is what we call sustainability. So the sustainable development is, you develop, but without compromising the ability of future generations to meet their needs. So that is why we have been asked to be careful of water consumption. Don't waste water. Don't pollute the air, right? Because we want our future generation to live in this earth, right? So because of that, that is what the sustainability is. So it's basically, you don't want people to pollute the environment to do something that can have an impact upon our future generation. The society is very concerned about this one. Companies are concerned about this one. So even the food that you produce, the kind of food that is given to the children, particularly, the society is very, very angry in a way, and sometimes they react very harsh. So basically the sustainable development, they recognize without environment, business and society will not exist. For you as an individual to exist, for me as an individual to exist, for our family to exist as a society, and our business to exist, we need the environment. And therefore, it is realized that the environment, we must take care of the environment. And that means we must take care of the wider stakeholders. It's not only the shareholders, the wider stakeholders. And particularly, the changes in climate and all that kind of thing are taking the company, driving the company to show how they are contributing towards the environment success or the environment performance. So, what are you doing? What are your contributions to global warming, right? The waste of water, the air pollution. So these are the things. So the sustainable have gone into particularly all over the world, particularly in the economic crisis, but they realized was the society's inability to pay the debts. So reporting is basically focused on prevention and mitigation of harmful little children. So we have a big duty to care for the future generation. And that is what we call the sustainability. Now we come to a very, very important area, what we call Global Reporting Initiative, the GRI. And this is a new part of your syllabus. So actually this was done somewhere in 1997. It was introduced as a kind of a long-term multi-stakeholder by a voluntary organization. But today it has grown up so much, and I think CIMA has introduced something completely on this area, and we are supposed to know this Global Reporting Initiative, their principles, all that can. This was updated. And now we have what we call the GR4, that is the 2013 thing. So their mission was to make sustainability reporting standard practice by providing guidance. So they are the people who provide guidance as to the reporting style, as to the reporting format. So that is the mission statement. So it was a voluntary organization. They developed the sustainable reporting framework. So it's good for you to go through some of these websites. I'll send you a paper for you to have a good look at some of these sustainable reporting GRI initiatives. Ultimate aim is to make these operations more sustainable. That means more focused on the environment, more focused on the society by setting goals. We must set goals to look after the environment. We must set goals saying that our air pollution is so many kilograms, right? We must set goals saying that the wastage of water will be limited to so much. We must set goals saying that our noise pollution will be, less than so much. So, and you must have goals. You should be able to measure performance and manage the changes. So that is what this GRI initiative basically brought it up. So there are some guidelines given by the GRI. So as I said, these guidelines have been changing, and now we have the latest one, which is called the G4, which was introduced just 1 year back. or not even 1 year. Yeah, 1 year back, May 2013. So these are the guidelines. So let us revise guidelines in May 2013. It offers the option for the organizer. So these are the sustainability reporting guidelines. So organizations are given the option. One thing they can go for what they call a co-option. Other one is what they call a comprehensive option. So the co-option will contain only the essential elements of sustainability reporting, which we are going to discuss in a minute. Essential elements of a corporate sustainability reporting. Comprehensive option will give more additional information or more additional reporting on things like governance, ethics, integrity, etc., etc. So in most of the places, the GRI are still voluntary, not mandatory, voluntary, but in some countries it's a law. But most of the countries, UK and rest of the world, it is voluntary. And organizations can decide whether they should go for the co-option or whether they can go for the comprehensive option. So basically, the guidelines are coming up in seven sections. So it's a big document, 94-page document. It is available in the website. If you go, you can find it out. But it is coming up in 7 sections. The section 1 and 2 basically talks about the purpose of the guideline and how to use these guidelines. So that is what the first 2 sections are talking about. And the section 3 says who should be applying these guidelines, the criteria, right? The criteria. So all the listed companies should be applying the criteria. Then the section 4 talks about the reporting principles, right? What are the reporting principles? So there are a couple of reporting principles which we will talk about it in a moment. Then the section 5, the disclosures, the standard disclosures, what we must disclose. So there are 2 kinds of disclosures, general standard disclosures and specific standard disclosures. And 6 and 7 is basically the links for key definition of terms. What are the terms, what they use and how we should interpret those things. So that is what. So basically what you have to remember is the companies either can go for the co-option or the comprehensive option. That option is given to us. There are 2 types of disclosures, the general standard disclosures and the specific standard disclosure. So we are going to look at the general standard of disclosures. General standard of disclosure. So there are 7 general standard of disclosures. What is required? 7. So these are typical short questions you can have it. They might give something and ask you to list out all what should come up under the general standard disclosure. So number 1 is about the strategy and analysis. So it basically provides a general strategic view of the organization sustainability, right? So it's basically your statement from the most senior decision makers, the directors or the CEO about the relevance of sustainability to the organization, right? How important the sustainability to the organization. So that way you admit, you accept that sustainability is key for our organization success. Then about the organization profile, right? So it basically talks about the products, markets, locations, ownership, all that kind of a thing, what can be of an relevance to you, right? Then you have to decide the materiality. Not that every information will have to be put it up on the report. If you put that kind of a report, that report becomes too much and the people will not read it. So you have to decide what are the boundaries, what is material, what will have an impact upon the decision maker making a decision on our company. You must consider all the stakeholders, right? Every stakeholder should be considered in the GRI analysis. Then the report profile, right? It basically gives an overview of the basic information of the report. Then the reporting period, the previous report, and whether we have applied the co-disclosures or the comprehensive disclosures. Sixth one, the governance issues, right? So disclosure should be provided over the highest governance, that is the board of directors, right? So the composition of the board of directors, the risk management committee, audit committee, so all that should come up. And finally, but not the least, the ethics and integrity. So it basically provides the organization's value on ethics and integrity. So at this point, I want to show you a report, a report of a real GRI. I'm going to send you this report, but I just want you to get an idea of this report, the GRI report. Where you got one? Yeah.
You know, the GRI will most likely be tested in the actual case study, not in the OT. I mean,
OT, you might have certain questions, the two options, for example, and the seven these things you might be asked.
Okay.
Yeah, there can be the framework, all that, because with 60 questions, there could be lot of GRI questions because there's a new areas. So this is a report that I picked it up, a report that had been prepared by the Dow Chemicals. So I'm going to send you this just to get an idea for you, the things that they mentioned in the report, right? So basically what is in the report. So you can see there's a letter from the CEO and about the sustainability overview. Sustainability overview. So strong environment, health and safety, personal injury role. So how they have improved it, injury severity, process, so safety. So like that they will be talking the challenges what they have for the next year, right? So basically in this case they have said about breakthrough in the world challenges, right? Energy, water energy, and so on and so forth. It gives you almost the climatic change. So addressing the climatic change. So like that, there'll be many things that they will be talking about. Energy efficiency. So I'll send you this report for you to get an idea of the kind of questions that can come up. And we will be looking at some other questions on the short term. So the standard disclosures, as I said, these are the standard. Then we have a specific standard disclosures. Specific standard disclosure. So they are the management approach, right? The management, how the economic, environment, and social impacts are managed, related to the material respects are managed. The big ones, how they are managing, and also about the indicators. So GRI indicators is a very key one which we are going to look at quickly. So GRI indicator. So there are three indicators of GRI: economic, environmental, and social. Economic, environmental. So these are the possible short questions, Majid. They can put up and ask, what are the GRI performance indicators? Economic, environmental, and social. So economic, basically it is concerned about the entity's impact on the economic condition of the stakeholders. Surely not the financial conditions, the economic condition, the lifestyle, the living standard, right? It's not what you are going to pay, but has it improved the living standard of your employees? Has it improved the living standard of your stakeholders, the shareholder, suppliers, right? It's not what you paid, it's not the financial, it is your economic consideration. Then the social dimension, right? How are you interacting with the social systems which you are operating? What are your charitable contributions you are making? How much you are putting into the society? That kind of impact. So then the environment. Environment is basically how you treat the environment. Things like your how you are protecting the natural systems, the air, water, etc. So this morning we had this Pope Francis visiting Sri Lanka, right? 78-year-old old person, but he came from the flight coming down the stairs as if like a 25-year-old young man. So yeah, very fast. I mean, for a moment we didn't realize that he's so old, 78 years, but very smart. And so later on they were discussing with one of the Catholic Church senior members, how is this man looking so young and fit? So what they said was, basically he's moving more with the nature. He's not staying so much in the air-conditioned rooms and all that. Right? He's moving with the nature. His food is natural food. So doesn't eat too much of artificial, all that kind of a thing. Fit man. Fit man. For 70 odd years. So basically, we can see today our children are getting sick. All these. Why? Mostly because our water is polluted, air is polluted, everything is polluted, and the food what we eat is all poison what we are eating, basically, because it's all chemical, processed chemicals, all that kind of thing. So in this our country we have lot of problems. My daughter herself is suffering with a kidney failure. So so much of issues in this thing which were not there 6 years back, 10 years back. Suddenly the things are developed because the people have become so greedy for money. They cultivate things with all the chemicals. They do everything with chemicals, and the people eat also all chemically processed food like Kentucky and all that. The little children, they ask for these things and we give it, but we know surely. So environmental dimension, these are all killing us. So let's look at about economic indicators, right? So the economic indicators are basically about the economic performance, the market presence, right? So so you can, some of the indicators you can have is proportion of spending with local suppliers. How much are you spending on local suppliers? How much are you spending on your foreign suppliers? Proportion of local force employed by the entity. Now that's trying to uplift your economic standard of the people. If you are going to employ a lot of foreign staff, that is not going to. So recently our president lost the election. One of the reasons that was told us, because we had a civil war in this country, and then it was over, and actually this man, the president, the outgoing president, he only won the election, the war for the people. But when that particular area was rehabilitated, he did everything beautiful, the new roads, all super class, but he did not employ any of the local people, local community. He got all Chinese labor and Korean labor, and they were the people who did it. So the economic lifestyle or the living standard of the people did not go up. And the people outvoted him. After saving them from the terrorists and everything, but still people outvoted him. The reason for analysis what was told was that, our economic standards never went up. True enough, we had nice road. True enough, we had nice airports. True enough, we had nice sports stadium. But we never got an opportunity to do anything. So how much local people you are employing? What are the wage rates? What are the pensions and other benefits you are paying? What are the taxes that is being paid? What are the subsidies that you have received? What are your procurement practices? Right? So all that is what we call the economic indicators, which are very, very important. So if you are doing well on those, you will be recognized. Then the environmental indicators, right? How you are going to use material, energy, water. So things like percentage of recycled material used in production. Right? Level of greenhouse gas emissions, level of organic ingredients used in product. So these are what we call environmental indicators, right? So effluent, waste, compliance, transport, supplier environmental assessment, products and services. So all that is environmental indicator. So you have to have some measurement to measure these things. Then we have the third one, the social. Yeah. When the social comes up, it is split into more. You have these fellows, the tough fellows, the unions, right? The labor, wages, not fair, strike. So we have to see that we manage these people. So the human rights, right? The labor relationships, the breakdown of your workforce by ethnic backgrounds. So you are trying to say that you are not going to be discriminative, right? Gender discrimination, the females and the males should be paid the same amount. So diversity, equal opportunity, training, education, health and safety. So that kind of thing. Policies in respect of working hours, labor practices, right? Night working safety, the women's safety. So all those things, healthcare, the gym membership, all those are things that has come up in the recent past, and these are what we call the social indicators of the GRI. That's not all. The human rights, right? Again, we have to think about our children, right? So we should, whether the child labor is being used, the investment in human rights, right? The child labor, freedom of collective bargaining. Some other companies, they don't allow you to form up a union, right? So human grievances, assessment. So all that is what we are being supposed to do. Then, next one, society. We have a responsibility towards the society, right? We are doing business, but the society people are starving. The people don't have a meal, but we are going in limousine vehicle. If that is the case, that's not a good organization. So what about the local community? Anti-corruption, right? Where do we give bribes and get the things done? Anti-competitive compliances, a grievance impact on society. The society may put a complaint against you saying that you are polluting the environment, you are creating more noise. You have many things to do. You can ignore or you can do something better. So this is, so the business community, what I'm trying to say, the board of directors under a lot of pressure to maintain all these things. Then the product responsibility, very, very important, right? The product that we are putting into the market, the customer health and safety, labeling, that you do the right label, don't try to mislead the people, communication, the customer privacy, right? When a person buys something, you should not go and publish it and say so and so bought this thing, you know, all that kind of a thing. Compliances. So this social area, you can see it goes into many areas. Human, the workforce, social product responsibility, all that. So we have to balance all these things. So what are the reporting principles we are talking about in the G4? Basically, the reporting principles are the stakeholder inclusiveness, that our report must include every stakeholder. So we have to identify the stakeholders and we have to say how the report is responding to that one. Then the sustainability context, right? It must say that it has considered the entity performance from the social and the environmental perspective. So your financial reports does not provide this information. That is why we have problem. So now these GRI fellows have come out and told what are the reporting reports. So these are some of the short questions you can come up. So there are five main things. Materiality. Only the important aspects should be reported in relation to economic environment. So don't try to improve too many things and lose the value of the report. It should be complete. All material things should be complete. And if it is, you are not going to disclose, you must give reasons for it. There can be exceptional reasons why you are not going to disclose it. So in that case, we must clearly say that this side information is omitted and why it has been omitted. So you can just omit and wait. You must say clearly, this particular area, we have not disclosed it, and for this reason, and for that reason. Maybe economic, maybe social, or whatever it may be. For example, you may be having a particular case with the labor union. In that case, you might not disclose all the social labor problems area because there's a court case pending in the court, and that you will disclose it. So, I saw a short question on this area, the omission for disclosure. If you are not going to disclose, or if you are going to omit the disclosure, it should say this particular part of the standard is not applied. So you remember there were 7 specific disclosures. You must say general disclosures, and you have not applied this area and why it is so. why it is so. And one reason why we can omit disclosures is that confidentiality. Due to the reason of confidentiality, we can't disclose it. Maybe that some top VIPs have bought certain things and you cannot disclose it, and therefore it is confidential. Specific legal prohibitions. Maybe a case, there's an injunction saying that you cannot disclose these things till the case is decided. So then it's a justifiable omission. And currently information is not available, but that is not an excuse to omit it. But you can say at the moment we don't have this information, but we are taking specific text to obtain the information, and we will give the information maybe in particular time, whatever it is. So that kind of thing is very, very important for all of us. Then the next one is about the 4-step approach for reporting. So there are 4 steps, but they have put it up on the GRI as the reporting guide. Step 1, identification. Identification. You have to identify the GRI aspects and other topics of interest. So the board of directors must identify the GRI aspects and the other topics of interest, and identify where the impact is, the big one, right? And within or outside the organization. And then step 2, prioritization. You have to prioritize based on the materiality. You remember when we were doing the P3, we were talking about the risk, the probability of it happening, and the impact. Similarly here, on the 4-step approach, prioritize based on the materiality and the stakeholder. So in the stakeholder, we have to think about the key stakeholders. High power, high interest people. Now those people we cannot exclude it. We may exclude some of the low power, low key, low interest people. But high power, high interest should be included. And then validation. Validation is you must recheck it and see what your information, what you are going to provide is reasonable, and it's a balanced representation. It's not one-sided. It is not something that you want to make it up, but it is balanced information. And the other one is about review. Ensure all what material in the previous year included. So don't ignore anything. Don't ignore anything. So this is what core. So the reporting quality, the principles of reporting quality, the quality is basically it should be a balanced report. And it must have comparable information. And it must be accurate. And it should be timely. And it should provide clarity. And it should be reliable. So when you prepare a GRI report under G4 guidelines, it should be a balanced report with comparability, accuracy, should be sufficiently accurate at least, should be timely so that people can, you can't give a report for 2012 in 2015. It should be clear, clarity, more clarity. And finally, the reliability. The report must be very reliable so that people can act upon the report. Very important. People can act upon the report. Right. So we have finished up one area of reporting, but I have some more to be done. That is on just like the GIR, the GRI, there's another one we call integrated reporting. And also little about IFRS 7. So next session when we start, we will take 5 or 10 minutes on that area also and finish it up.
Okay.
Right?
Yeah. I was going to ask, have you got the pass cards?
Yeah, pass cards are there. The latest I we have ordered. If we should get it today, tomorrow, we should be able to give it to you, the pass cards. Yes, surely. Okay.
And then also, when are we meeting again?
Now that's now Saturday, Sunday. Give me a minute because I want to. You have a bit of issue this Saturday, Sunday, then timing. So how is your program on Saturday, Sunday? Because
Sunday I'm fine, but I was just going to ask if we could just bring it back like 15 minutes.
Sunday.
So starting at 8:45 instead of.
The problem is Sunday I'm not available. Sunday I have to go to outstation for a church service. So I was wondering whether we can do it Sunday evening, late evening, because Sunday I have a problem because I have to go to about 100 miles away for a church service. So by the time I come, it will be very late. So I was thinking whether we can do it Sunday at about 2 o'clock in the afternoon. Sunday.
I won't be able to do it at 2 o'clock in the afternoon because I've got a lesson.
Right. Saturday, how are you in the late in the evening?
Yeah, Saturday late in the evening should be fine.
Say what time? 7 o'clock? Is it all right by you?
Yep, that should be fine.
So Saturday
that's fine.
Saturday we'll keep it for 7. Sunday also, is it 7?
Okay.
Okay for you? Sunday.
Sorry, what time?
Sunday also 7 o'clock.
7's too early.
No, 7 in the evening.
What, in the evening? Yeah, that should be fine as well, yeah.
Yeah. So shall we keep for this weekend only, Saturday and Sunday at 7 o'clock?
Okay, that's fine.
Yeah. So Saturday.
And then if you could try and get the.
What is that?
Yeah, if you could try and get the pass cards to me.
Yeah.
Please.
Yeah, pass cards are basically the revision notes. So you can, that's a good thing. I'll try. I'll try because we have ordered it. So I should get it today, tomorrow. I will be able to give you the pass cards Saturday, Sunday before that. Yes, surely. So Saturday we are going to look at the subject called ethics. Saturday. Did we do the corporate governance? No. Yeah, so we had to do the corporate governance.
Not all of it, no.
Yeah, and the dividends also. So I'll send you what I'm going to do it Saturday and Sunday. So Saturday, Sunday this week we will meet at 7 o'clock in the evening. Okay?
Okay, perfect.
Right, okay. Thanks, Majid. I'll see you on Saturday.
Have a good week.
Thank you. Bye.
Okay, take care. Bye-bye.
Bye.